And now it's time for Development Debates. We dig deeper into some of the questions shaping the future and present of China. Today we'll see two experts debate if Procter & Gamble are taking too big of a gamble. Less can be more, but in China that's not often the thought. It's normally more about dumping goods and overcapacity. The term bo li do xiao comes to mind, which means small profits but large sales. Procter & Gamble, the world's largest consumer product company, has plans to dump about 100 of their brands. They are doing this to focus more on the top 70 to 80 brands. Big changes are expected to be made following this move. Some market insiders believe the move will help them consolidate their resources and concentrate on making its existing brands even stronger in the Chinese market. According to sources close to Procter & Gamble China, details of the final portfolio still haven't been announced. There's been no disclosure so far in the 70 to 80 brand portfolio. Each brand they keep, though, will have strategic benefits with potential to grow. China Daily reported that these 70 to 80 brands are leaders in their industry and are preferred by consumers and retailers. China has a lot of room for growth and value creation in the future. Procter & Gamble said those core brands have accounted for 90% of sales and more than 95% of profits over the past 3 years. 23 of the brands have recorded sales of between $1 billion and $10 billion. So the big questions now are if this round of streamlining activity will inject new vitality into Procter & Gamble. And is it a gamble for the fast-moving consumer good giant? Feng Jianjun, an industry expert, has doubts about its short-term success. Feng said that it takes a relatively long time for FMCG companies such as Procter & Gamble to make a U-turn. The streamlining plan won't have an immediate effect. Feng said, quote, "In Procter & Gamble, the change of middle and senior level management staff usually takes about 3 to 6 months, from which we can see how complex the company and its structure are." Feng said in brand building, Procter & Gamble China meets the same difficulty with its parent company. He added the sales volume of the Chinese branch accounted for about 1/10 of the global market share. The core products are the main source of revenue. Feng added that developing a strategy for Procter & Gamble should be different from L'Oreal. He explained that Procter & Gamble has tried to develop products in various fields, but finally lost its key market. Feng said, quote, "For the Procter & Gamble brand, the advantages of famous products are diminishing fast." Procter & Gamble reported that in the fiscal year of 2014, that net sales increased 1% to $83.1 billion. Its fourth quarter net sales were $20.2 billion, a decrease of 1% year-on-year. Feng concluded that even if the streamlining plan worked to some degree, then there would still be questions about its long-term strength. In contrast, Pan Yifan has a lot of confidence in the streamlining plan. Pan is a senior partner at Alliance PKU Management Consultants. He said the new policy seems to be a long-term strategic transformation, rather than a short-lived adjustment for the brand. Pan said through this round of transformation, capital, human resources, and prioritizing markets can be done more effectively. From his perspective, in this sluggish economy, focusing on key brands is the right thing to do. Pan said that even if the streamlining plan were a life and death choice, then this would be the way to go. He said, quote, "Like a gecko, Procter & Gamble has to bite off its own tail to survive." The underperformance of consumer brands is an industry struggle. A recent Kantar World Panel report revealed a deceleration in the growth of China's fast-moving consumer goods sector, and that foreign brands have faced fierce competition from local players. According to the report, growth in the coming 5 to 10 years will come primarily from share gains in mature categories, like shampoo and laundry detergent. And it's imperative to focus on building brands that matter to Chinese shoppers. Procter & Gamble is making a major move here. Many of these goods have low profit margins and rely on brand awareness. Since the Chinese market is so different from others, they have to take less than conventional approaches. But the company has many other challenging markets, so it's likely already has measured the risk and benefits of this move.